The financial press frequently relies on the phrase flight to safety to describe what happens when markets break down. Traditionally, analysts define these events in hindsight. They look for days where the correlation between stocks and bonds crosses an arbitrary negative threshold and label that a panic. That approach is mathematically loose. A fixed threshold cannot capture the unobserved shifting dynamics of how institutional capital actually flows during a crisis. Researchers Bale, Beckert, Engelbrecht, and Way developed a solution to this problem, a bivariate regime switching model. To identify a true flight to safety, their model requires exactly two inputs. The first is benchmark equity returns. The second is benchmark sovereign bond returns. The objective is to discard media sentiment entirely. The model isolates the flight to safety effect strictly from the hidden volatility and return patterns of these two assets. Real market panics generate an exact mathematical signature that operates regardless of the human narrative surrounding it. The framework assumes the market is driven by three distinct, unobserved states that have to be probabilistically inferred from the data. The first two are the equity regime, labeled SE, and the bond regime, labeled SB. Both of these chains are constantly toggling between state 0, which represents low volatility, and state 1, representing high volatility. Under normal conditions, these two Markov chains operate independently. High stress in equities does not automatically dictate high stress in bonds. The third unobserved state is the flight to safety regime itself, labeled SFTS. The model places a strict mathematical constraint here. A flight to safety can only initiate if the equity market is already experiencing severe stress. If the equity regime is in state 0, low volatility, the probability of the flight to safety state activating is mathematically forced to 0. A flight to safety is a highly specific, conditional anomaly that only spawns inside an existing high volatility environment. To track how prices move within these states, the researchers constructed expected return equations for both equities and bonds. Time variations in expected returns within this framework are driven primarily by discrete variables called jump terms. These standard terms track set-in regime shifts. JLH triggers when volatility drops from high to low, and JHL triggers when it spikes from low to high. The model enforces sign restrictions to ensure expected returns stay higher during high volatility regimes. Investors naturally demand a risk premium to hold volatile assets. But when a crisis hits, the specific flight to safety components activate and override those standard risk premiums entirely. The first of these is JFTS. This binary jump term equals exactly 1 only on the very first day of the panic. The researchers applied rigid inverse sign restrictions here. The alpha FTS term is locked negative, forcing equities to fall, while the gamma FTS term is locked positive, forcing bonds to rise. These mathematical constraints force the two asset classes to decouple. They bypass normal correlation patterns and simulate the exact mechanics of a sudden capital flight. On day 1 of the crisis, the negative shock to equities reaches its absolute maximum magnitude, defined as 1 plus VE times alpha FTS. If the regime stays active on subsequent days, the sheer intensity of that initial shock begins to decay. We can evaluate the absolute worst-case scenario by looking at the expected equity return state, ER11. This describes a market where equity volatility is high and the flight to safety regime is actively running. Here, the massive negative weight of the flight to safety jump term overwhelms the standard risk premium. Expected equity returns drag deep into negative territory. When the panic finally breaks, the regime switches off. The model registers this conclusion with a final variable, the flight to risk jump term, JFTR. The sign restrictions here are flipped. JFTR dictates a positive shock for equities and a negative shock for bonds as capital suddenly floods back into the risk markets. Mathematically, a flight to safety functions as an acute, decaying shock with a highly specific half-life. When the researchers applied this strictly constrained model to daily historical data across 23 global markets, the results revealed an intensely acute phenomenon. Qualitative media narratives frequently describe panics as enduring for months. The empirical data proves otherwise. The first empirical finding is one of extreme rarity. Mathematically defined flight to safety episodes make up less than 2% of the historical sample. The duration of these shocks is shockingly brief. Exactly 94% of identified events resolve in 3 days or fewer. What happens during those narrow 72-hour windows is an extraordinarily intense reallocation of capital. This chart plots the average daily return differential between benchmark bonds and equities during one of these events. It hits an extreme 2.72%. True institutional panic is exceptionally rare and violently short. The vast majority of media-reported sell-offs simply fail the mathematical test for a true flight to safety. The 2.72% differential represents the footprint of massive institutional capital movement. Historical fund data corroborates the model, showing verifiable outflows from equity funds and aggressive inflows into government bond and money market accounts during these windows. You might assume that sophisticated institutional portfolios, particularly hedge funds, would easily navigate these tiny windows of risk and provide downside protection. But the data exposes a counterintuitive reality. Nearly all hedge fund styles exhibit negative exposures to these events. Their systematic exposure steadily climbs up to 60 days before the shock, crashing sharply right before day zero. This late-stage accumulation of risk leaves the funds highly vulnerable, right at the exact moment the initial flight-to-safety jump term strikes the market. The bivariate regime switching model replaces qualitative sentiment with a rigid mathematical framework. By identifying panic through the latent dynamics of benchmark returns, we find that true institutional risk aversion dismantles the market over hours and days.